Hi, everybody, and welcome back to video number 6 in Chapter 10. When we left off, we were looking at the Modified Accelerated Cost Recovery System makers for different tax lives for different kinds of property. So here are those different kinds of property. We have 3-year property, 5-year property, 7-year property, etc., all the way down. And you can see what items are included in those property categories. So makers uses accelerated methods, of course, and let's take a look at how that looks. Here is a schedule, which I think is very interesting if you haven't seen it before, the IRS's table. Now you'll notice, let's go to a double declining balance item here for 5 years. 5 years we know for straight line is 20%. So double declining is going to be 40%. You'll notice here that that's 20%. Makers uses a half-year convention. So here, that's going to be 20%, not 40%. But then you have a 6th year here. Okay. Now, the other thing that's true about this is that when it gets to a certain point, it flips over from accelerated double declining balance to a straight line depreciation, which you can see with these asterisk items here. So it's an interesting schedule from that standpoint. Okay, so here we're going to look at how that looks under GAAP, straight line, and makers. So here's our acquisition cost, 100,000, estimated useful life, salvage value, 5 years we're going to use for makers, but 7 years we're going to use for GAAP. And double declining balance they're going to use for makers, but GAAP we're going to use straight line. And then we have disposal proceeds expected in the year 2032 of $11,000 salvage value. Okay, so if I look at this from the standpoint of makers depreciation, here I have my $100,000 here, and our total depreciation is going to be $100,000 over the life of that asset between 2025 and 2030. Now, for GAAP, we're going to take the 100,000, subtract. One last note on that. You'll notice that we did not subtract out salvage value in makers. We do not subtract salvage value from makers. Okay, but under GAAP we do. So here we take the 100,000 less the 16,000 divided by 7 years. That's $12,000 per year. 7 years, $84,000, compared with $100,000 taken through 2030 a little earlier. Okay, interesting. So the optional straight line method applies to 6 classes of property that we previously described, and it applies to the straight line method to the maker's recovery periods, and it ignores salvage value. Okay, so what we're going to do, tax laws and financial reporting have different objectives, as I think we all know by now. Taxation is to raise revenue from the constituents in an equitable manner, whereas financial reporting is to reflect the economic substance of a transaction as closely as possible and to help predict amounts, timings, and uncertainty of future cash flows. Very important. Future cash flows. The adoption of one method for both tax and book purposes in all cases is not in accordance with GAAP. Okay? Not. All right, now let's compare accounting for property, plant, and equipment under GAAP and IFRS. Here, under IFRS, the definition of property, plant, and equipment is basically the same, similar. Another similarity under both GAAP and IFRS, changes in depreciation method and changes in useful life are treated in the current and future periods, and prior periods are not affected. 3, the accounting for plant asset disposals is the same under GAAP and IFRS. And 4, the accounting for initial costs to acquire natural resources is similar under GAAP and IFRS. And 5, both GAAP and IFRS interest costs incurred during construction must be capitalized. Recently, IFRS converged to GAAP. Very nice. More similarities. The accounting for exchanges of non-monetary assets has recently converged between IFRS and GAAP. GAAP now requires that gains on exchanges of non-monetary assets be recognized if the exchange has commercial substance. This is the same framework used in IFRS. Number 2, GAAP and IFRS both view depreciation as allocation of cost over an asset's life. GAAP permits the same depreciation methods, straight line, diminishing balance or declining balance, units of production, as does IFRS. Differences. IFRS requires component depreciation. Under GAAP, component depreciation is permitted but is rarely used. Under IFRS, companies can use either the historical cost model or the revaluation model. GAAP does not permit revaluations of property, plant, and equipment or mineral resources. And 3, in testing for impairments of long-lived assets, GAAP uses a different model than IFR to test for impairments. As long as future undiscounted cash flows exceed the carrying amount of the asset, no impairment is recorded. The IFRS impairment test is stricter. So, however, unlike GAAP, reversals of impairment losses are permitted under IFRS. All right, that ends Chapter 10. And when we return, we'll take a look at Chapter 11. Until that time, bye for now.